As you might know by now, July PPI came in hotter than expected. Many Fed officials prior to the print were on the fence about a rate cut in September, with one president on the FOMC emphasizing inflation as the Fed's priority. Our Steve Leisman's here at Post 9 this morning with St. Louis Fed President Alberto Musalem. Morning, Steve.
Good morning, Carl. Thanks very much. We are pleased to be joined by President Musalem for his first interview on CNBC. Thanks for joining us, President Musalem.
Good morning, Steve. Great to be with you. Good morning, Sarah. Good morning, Carl.
So it's too bad we don't have all that much to talk about. Let's begin with, I think, a very simple question that you might have expected, which is, give us your view, how you put in context the inflation situation, given that over the past 2 days, we've had the CPI report and the PPI report. How much concern or lack of concern do you have now with the inflation picture as it stands, as we know it?
It seems to me that looking at both reports, inflation is running around 3%, close to 3%. When we look at the PPI core, the PCE core or the CPI, that's 3.1. And I've seen some private estimates of a potential PCE at 2.9 given today's PPI and the CPI release. So that tells me inflation is running at about 3% or very close to 3%, which is about 1% higher than our 2% target. Now, tariffs are feeding through. Companies told us that it would take about 3 to 6 months to pass on costs once they felt the costs. We're right around that 3-month mark. July data is 3 months after April. I expect the impact of tariffs, most of the impact of tariffs on inflation to fade after 2 to 3 quarters, so in 2 to 3 quarters' time. But there is a reasonable possibility that they could be more persistent.
What's the right stance of policy given how you set out those probabilities? There are obviously some people on the FOMC who are willing to cut rates right now because they have a higher degree of faith in the pass-through. Others are a little more concerned that they're not ready to take that chance. Where do you stand in that regard?
So we have a dual mandate, as you know. We have to look at both sides of the mandate. So inflation, price stability, and employment. We need to make sure the labor market remains strong and at full employment. And so how I'm thinking of policy, and I've been saying this since February of this year, when we see tension between our two mandated goals, we need to follow a balanced approach, which is to think about 3 things: the probability of a miss on employment versus the miss on inflation, the potential size of the miss on each side of the mandate, and the potential duration of the miss on each side of the mandate. So I'm weighing both things. I'm weighing both the fact that inflation is almost 1% above our target, with the fact that we have a labor market which is at full employment, but there are risks to the downside also.
I don't want to seem like I'm too focused on the inflation mandate. Let's talk about that employment mandate. Again, I'm hearing different things from different members of the committee. I've heard words like solid ascribed to the jobs report. I've heard other words like weakening ascribed to the jobs report. I think both of those can be true at the same time. Alberto, there are some people that are looking at the level of payrolls, which has been flat to down, and there are some people looking at things, ratios like the unemployment rate. Can you explain to us how you look at it and what conclusion you come to? Weakening, solid, somewhere in between?
So I see the labor market as stable around full employment. We have an unemployment rate at 4.2%, which is consistent with full employment and, low by historical averages. We have a ratio of vacancies to persons unemployed, which is above 1, meaning there is more than 1 vacancy, slightly more than 1 vacancy for each person unemployed and looking for a job. We have the transition rates from employed to employed are consistent with a full employment labor market, and the employment cost index is consistent with a full employment labor market. Now, there are some signs of weakening. Payroll growth has been low. There were very large revisions, as you know, to the last 2 months of reported data. The story there is the demand for labor has declined, but so has the supply. And that's why looking at levels may be less informative, that is levels of payrolls, than looking at ratios. and that's why I'm looking both at levels and at ratios. You may recall that last year we had a break-even pace of employment that was north of 150. This year, with lower immigration flows, it's reasonable to expect that break-even rate to be sub 50. And in fact, in spite of historic revisions, these were 3 standard deviation revisions, which you should expect once every 2 to 3 decades. In spite of those revisions to the level of employment, the unemployment rate stayed unrevised, which tells me that the supply of labor also declined, or cooled, let's say that.
President Musalem, it's Sarah. So I'm trying to parse all of your words and your views on the labor market and on inflation. And I know we have a month till the next meeting, and you don't want to pre-commit to anything. But right now, are you leaning toward cutting in September? Because the market's pretty confident that that's what you guys are going to do.
So, Sarah, I take each meeting at a time, is meeting by meeting approach. And I bring a very open mind and a pragmatic mindset to each meeting. I try to be as forward-looking as possible. Over the last 2 months, I've been revising my assessment of potential weakness to the labor market slightly higher. I have revised my assessment to the persistence of inflation slightly lower. I don't want to, as you said, prejudge the meeting because I feel my responsibility to the public to continue to update my outlook and balance of risks with new information, data, and otherwise that will happen between now and the meeting. In fact, I find myself updating my outlook even on the day of the meeting some days. So for me, it's too early to say exactly what policy I will be able to support. But I am coming with a very open mind and with a pragmatic approach. And I am focused, as I said earlier, on the dual mandate and a balanced approach to it.
But it sounds like, and you just said it, you're a little more worried about jobs than you are about inflation at this point in time, as far as the outlook.
No, I'm concerned about both at the same time. I see risks, although not my base case. I see risks that inflation could be more persistent, and we're only 3 months into the tariff imposition period. So the data is beginning to give us some indication as to whether the possibility of more persistent inflation is there. And at the same time, we have an economy on the labor market side, an economy that is growing at around 1%, slightly below 1%, expected by private forecasters for the second half. So that poses downside risks for the labor market. And also we have pressures on some company margins. For example, the CPI was relatively well behaved except for the core, but the PPI came in high, so that suggests possibly some margin pressures. So slower growth and potentially margin pressures suggest some downside risk to the labor market. Now, that said, one thing that I do and all of the presidents do is we're in constant contact with businesses in our districts and around the country. And I'm not hearing from businesses that they are about to begin to lay off workers.
President Musalem, I'm curious to know how you and the committee, you think, are absorbing the administration's encouragement to cut. And if you're able to tune it out, how do you tune it out? How do you think it affects the color of the committee's meeting?
So elected officials are entitled to have a view on monetary policy, on the economy, particularly when they are very learned on the economy. My job is to listen to Main Street and to listen to the people that I represent and the businesses that are in our districts. That takes a lot of effort and time. I view my job also as tracking the economy in all its aspects. This is a $30 trillion economy, which is very complex with many moving parts. And those two things occupy 120% of my time. I should say that central bank independence is very important. It's very important because it leads to better economic outcomes, so lower and more stable inflation and higher, more stable employment. And it must come with accountability, which is accountability to Congress and elected officials and the people they represent through our dual mandate, which is current law.
Alberto, I want to pick up on what Sarah was asking, and I think people need to know that one of the great strengths you bring to the FOMC and to your job is your prior experience in financial markets. And what I have enjoyed about watching your speeches and talking is you boil stuff down to the thing that really matters. You started this interview by making the observation, inflation is running at 3, our target is at 2. What is at stake here for a Federal Reserve cutting when inflation is at 3 and your target is at 2?
So again, you have to balance two things. You have to balance the labor market side and the inflation side of the mandate. I think what I said is inflation is running closer to 3 than to 2%.
Fair enough.
And that certainly is something that is always in the back of my mind. At the same time, I look at the unemployment rate and I look at the labor market and I see some potential downside risks. And it's about thinking of a policy path that balances those two things. For example, if we were to weigh the labor market side of the mandate more and reduce rates aggressively, that may de-anchor inflation expectations, that may build term premia into the yield curve, that may steepen the yield curve, that may be counterproductive for borrowers in the economy, including mortgage holders, the government, companies, et cetera. So that's a situation we should try to avoid. On the other side, if we only weighed the inflation side of the mandate, we may do unnecessary harm to the labor market. We also don't want to do that. So it's a balancing act, and that balancing act is possible if inflation expectations remain anchored. So I'm always looking at what those are doing.
Alberto, we're almost out of time. Just very quickly, can you give us an idea over a course of time what you might look at? Is there is it the concern that tariff price increases are becoming inflation in other areas? And if you're not seeing that, does that make you comfortable to cut? Is there some particular metric that works for you?
So I'm looking at how what we hear from companies is companies that are close to the importer are passing on almost everything. Companies that are closer to the consumer are having an inability to pass through, and there are many stories in between. And so this burden is being shared by exporters, importers, consumers, intermediate goods. So what I look for is first-round effects, direct effects, indirect effects on non-imported goods and services, and potentially on wages and prices. So far, we've had muted impact on core goods and services. We've had some higher services inflation, which is unusual. I would have expected that to happen after an increase in inflation and core goods prices. So my sense is, again, companies told us it would take 3 to 6 months after impact. We're right in the beginning of that window for that first wave of tariffs. I think it's going to take another 2 to 3 quarters for tariffs to play through. I expect most of the impact to fade over time, but there is a reasonable probability that there may be some persistence, and we need to get a better fix on that, understanding we can't wait 2 years to do that, but a little bit more data would be helpful.
Is 50 basis point cut even in the realm of possibilities? Would you consider that? It's something the Treasury Secretary was talking about this week for the next meeting. From my perspective, it's unsupported by the current state of the economy and the outlook for the economy. That's a no. That's a no.
Thank you for joining us. I owe you a trip to St. Louis. I can blame the FAA and the storms yesterday, but thank you very much, and we hope to see you again soon.
Thank you, and look forward to next time.
Yeah. If I had a private plane, guys, I would have been there.
No, you wouldn't. The weather was terrible.
That's true. Even the
night.
private folks won't.